A single decision was quietly stealing nearly $900,000 from Ryan. He never saw it on a bank statement. It never appeared as a bill. No warning arrived in the mail. And that's exactly why it was so dangerous. By the time he realized what had been happening, 20 years had already passed. The strange part? Almost everyone watching this has made the same mistake. The world's biggest wealth killer doesn't announce itself. It whispers. Alex and Ryan had been close friends since university. At 31, they were finally where they had dreamed of being. Both lived in the same city. Both earned $90,000 a year. Both had saved roughly $70,000. Neither had debt. Neither considered themselves bad with money. In fact, friends often asked both of them for financial advice. On paper, their financial lives looked almost identical. But over the next 20 years, one of them would quietly build financial freedom. The other would spend 2 extra decades working. Not because he earned less. Not because he invested in bad stocks. Not because he made one catastrophic mistake. His wealth disappeared in a much quieter way. It started with a single sentence. Ryan looked at Alex one evening and said, "I'll start investing when I have a little more money." Alex nodded. It sounded reasonable. Because it was. Most people don't avoid investing because they're careless. They wait because they want to feel ready. More savings. More certainty. A better economy. A higher salary. The perfect time. Alex understood the feeling. He simply didn't trust it. The following week, he invested part of his savings into a diversified low-cost index fund. Not all of it. Just enough to begin. Ryan decided to wait one more year. After all, what difference could 1 year possibly make? That's the question almost everyone asks. Here's what nobody talks about. The greatest threat to building wealth isn't always making bad decisions. Sometimes, it's delaying good ones. Behavioral scientists call this present bias. Our brains naturally value today's comfort more than tomorrow's reward. Waiting feels safe. Taking action feels uncertain. Ironically, that feeling often creates the very future we're trying to avoid. Ryan wasn't wasting money. He wasn't chasing luxury. He wasn't gambling. He genuinely believed patience was the responsible choice. And for a while, it looked like he was right. His savings account kept growing. He slept well knowing his money was safe. Alex's investments, on the other hand, immediately faced market volatility. Within months, the market declined. Ryan smiled. "See, this is exactly why I waited." For the first time, Alex questioned his own decision. Had he invested too early? Had Ryan actually made the smarter choice? For a brief moment, it certainly looked that way. But markets don't tell the whole story in a few months. They tell it over decades. And neither Alex nor Ryan realized. The real wealth killer had already begun its work. Not through a crash. Not through inflation. But through something almost invisible. Time. 1 year passed. Ryan kept his promise. Almost. He had saved even more money than before. His emergency fund was larger. His income had increased to nearly $95,000. On paper, waiting had worked. So he postponed investing again. Maybe after the market settles. It sounded responsible. Even Alex couldn't argue with the logic. The headlines were frightening. Inflation remained high. Interest rates kept climbing. Financial news warned that more uncertainty could be ahead. Waiting felt safe. Investing felt risky. But here's the hidden problem. The market doesn't wait for confidence. It usually begins recovering long before people feel comfortable investing again. History has shown this repeatedly. Some of the strongest market gains have occurred shortly after major declines, often when fear is still widespread. Alex didn't know when that recovery would happen. Nobody did. So instead of predicting the market, he followed a simple system. Every month, regardless of the headlines, he invested the same amount. Some months he bought when prices were high. Other months he bought when prices were low. He removed emotion from the decision. Ryan removed risk. Or at least, he thought he had. His savings account earned interest. It felt productive. But after inflation and taxes on that interest, the growth was much smaller than it appeared. His money wasn't standing still. It just wasn't moving fast enough. That's what makes the silent wealth killer so dangerous. It doesn't destroy your money overnight. It quietly slows your future. The psychology is fascinating. People fear losing 10% in the stock market. Yet many never question losing purchasing power slowly to inflation while they wait. One loss feels dramatic. The other feels invisible. Our brains notice sudden danger. They often ignore gradual damage. Then something changed. 3 years after that first conversation, Alex opened his investment account. Despite the market's ups and downs, his portfolio had grown steadily through consistent investing. Ryan looked at the numbers in disbelief. I actually saved more cash than you. Alex nodded. You did. So how are you ahead? Because they had been measuring two different things. Ryan measured how much money he had saved. Alex measured how long his money had been working. And in investing, time often matters more than timing. Ryan finally decided to begin investing. It wasn't too late, but it wasn't as early as it could have been either. That small delay didn't feel expensive. It felt almost insignificant. But over the next 15 years, that invisible gap would quietly compound into something neither of them expected. 5 years later, Alex and Ryan were earning almost the same income again. Both had stable careers. Both were investing every month. From the outside, their financial lives looked nearly identical. Ryan finally felt relieved. I've caught up. It was an understandable conclusion. After all, they were now investing the same amount into similar low-cost index funds. The gap should eventually disappear, right? The numbers told a different story. Alex's earliest investments had been compounding for years. Every dividend was buying more shares. Those new shares generated more dividends. And those dividends bought even more shares. It was growth building on top of growth. Ryan wasn't just starting from a smaller portfolio. He was starting with less time. And unlike money, time can never be deposited later. Albert Einstein is often credited with calling compound interest the eighth wonder of the world, though the quote's origin is uncertain. Regardless of who said it, the principle remains true. Compounding becomes more powerful the longer it has to work. Then everything flipped. A global market correction erased thousands of dollars from both portfolios in just a few weeks. Ryan stared at his screen. Years of gains seemed to disappear overnight. His first instinct was simple. Maybe I should sell before it gets worse. Alex felt the same fear. The difference wasn't intelligence. It was preparation. Years earlier, Alex had made one rule. Never make long-term decisions based on short-term emotions. So he did. Nothing. In fact, he continued investing every month. To Ryan, it looked irrational. Why buy when prices were falling? But investors don't buy falling markets because they enjoy losses. They buy because every share purchased at a lower price has greater long-term potential if the market eventually recovers. Months later, the market began climbing again. Not because the news had become positive, but because markets often recover before public confidence returns. The shares Alex bought during the downturn became some of the best-performing investments in his portfolio. Ryan sighed. I was waiting for certainty. Alex smiled. So was everyone else. Here's what nobody talks about. The silent wealth killer isn't fear. Fear is normal. It's allowing fear to keep making your decisions. By year 10, the difference between them wasn't obvious in their lifestyle. They still lived comfortably. They still enjoyed vacations. But one difference had become impossible to ignore. Alex's portfolio was beginning to produce meaningful growth on its own. His money had started working even while he slept. Ryan was still relying mostly on the next contribution he made each month. One decision, 1 year's delay, and a little more hesitation. That was all it took to create a gap that would keep widening for the next decade. 20 years after that first conversation, Alex and Ryan met at the same cafe where Ryan had once said, I'll start investing when I have a little more money. Neither of them had forgotten that moment. Ryan smiled. I thought waiting 1 year couldn't possibly matter. Alex looked at him and replied, neither did most people. The difference between them had never been income. It had never been intelligence. And it certainly hadn't been luck. It had been time. Over 2 decades, Alex's portfolio had grown to approximately $2.2 million through consistent investing, market growth, and the power of compounding. Ryan had also built impressive wealth. His portfolio was worth around $1.5 million. He wasn't broke. He hadn't failed. In fact, most people would consider him financially successful. But every financial calculation pointed to the same conclusion. The 1 year he spent waiting had quietly cost him hundreds of thousands of dollars in long-term growth. Not because that single year was magical, but because every dollar invested earlier had 20 years to compound instead of 19. That's the math almost nobody feels. Because opportunity cost doesn't send a bill. It simply lets your future become a little smaller than it could have been. Here's the surprising part. Waiting isn't always wrong. If you're paying off high-interest debt, building an emergency fund, or investing money you'll genuinely need next year, patience can be the smarter decision. The lesson was never invest immediately no matter what. The lesson is to stop waiting for perfect conditions, because perfect conditions rarely exist. The market will always have uncertainty. The economy will always have headlines. There will always be another reason to delay. That's why the silent wealth killer is so difficult to recognize. It disguises itself as responsibility. It sounds like caution. It feels like wisdom. But sometimes, the safest decision today becomes the most expensive decision tomorrow. Real wealth isn't built by predicting the perfect moment. It's built by consistently making good decisions, even when the future feels uncertain. Alex didn't become wealthier because he knew something Ryan didn't. He became wealthier because he accepted one simple truth. Time in the market has historically mattered far more than trying to perfectly time the market. Ryan nodded. I spent years trying to avoid mistakes. Alex smiled. And I spent years trying not to miss opportunities. That single difference changed everything. If this changed the way you think about money, subscribe for more documentaries on the psychology of wealth and smarter financial decisions.